The central point about the trade war continuing between the United States and China is that the combination of rising dollar and falling yuan, both by about 7%, which we expect to continue for the next year or so, with the yuan perhaps going another 7% against the dollar, not against everything else of course, to about 7.40 to the dollar. That change has put a lot of stress on non-oil emerging markets, who are already in very large deficit and have been for a long time, and also, of course, upon the export-orientated developed market economies of the European Union, particularly the Eurozone, Japan, and the Asian tigers. And the point here is that, of course, the pain is therefore being spread. There's a little bit of benefit being spread in the sense that Chinese exporters to the United States will reroute a lot of their exports through other countries in Southeast Asia that are viewed favorably by America, and also a certain amount of manufacturing facilities will go that way as well. But for the most part, everyone else is going to suffer because they're going to be paying more for their dollar imports, and they're going to be competing with a more competitive Chinese yuan in the export field. And at the same time, because of the world slowdown, the growth of world trade has slowed as well, and that means a tougher competitive environment in a smaller global market. So we have here the makings of a general slowdown, which is not only in China and the countries I've just mentioned, but also, of course, in the United States itself, because the very high dollar means that US exports are much less competitive, and at the same time, the United States is facing a squeeze on its profitability and on its earnings from overseas subsidiaries, as a result of which the stock market is liable to be stressed as well. So one way and another, it looks like a rather ropey 2019 for all concerned.